I see many traders failing to hold on to their winning position and end up selling for a small risk reward or a small profit, when in reality they easily could have managed their position into more of a bigger position. Now, if this sounds like something you struggle with, make sure you stick around and keep watching. Now, first things first, if we're talking about psychology here, then you need to learn to desensitize yourself from the individual outcome of a trade. So, for a lot of traders, their approach is actually fine, but what sabotages them is themselves. Why? Because they're driven by fear. So what you need to do here in this case is you need to measure your success not on the next trade, but on the next 100 to 1,000 trades. So by thinking this way, you are desensitizing the importance of the outcome of this trade right now. If you just say to yourself, look, okay, this is just one trade of the next 1,000 trades I'm going to next, and kind of have it onto the next mentality trade, okay? So the key here is to obviously think in sample sizes, but also to adopt the long-term mindset. Okay, but with that being said, if you lack confidence, then you simply either need to refine your edge, i.e. put in more backtesting sessions or, data collecting sessions, etc. And once you have a bit of a rule-based system in place, then you can transfer that onto a live environment. So starting with demo trading might be a good option for you when you're ready, and obviously when you are ready after that, you can then jump into a live account scene. And if at first you still lack a little confidence, then which you most likely will when you first jump into a live account because you're risking real money, okay? Well then, if that's the case and you're still lacking confidence, then your best option would be to execute the trades but with a significantly lower position size. So for example, a 0.01, okay? Now this way you're actually getting used to executing trades in a live environment, but not also that you're actually getting used to executing trades on a live account, okay? And over time, you can increase your position size with time. Now, this is just something that I've been through personally in my career, and I've developed, pretty much everything that I'm about to teach you, and also in my previous videos, all for my students. So if you're wanting to drastically cut the learning curve and avoid all of that, then I would highly recommend joining my mentorship. But anyways, enough about that. Let's just jump straight onto the technical side of things on the charts. Okay, so there are a few different things that you can do, like I mentioned earlier, and one of those things, if we just kickstart it off, is just close 50% at a 1 to 2 and let the risk run. Okay, now what do I mean by this? Okay, so let's just say you enter a position. You're in a trade no matter how you trade, but in this case, this is just, bearish order flow. We see a shift in structure, maybe after a sweep of liquidity or maybe a POI mitigation. We see a shift in structure there, then a pull back into the breaker. Okay, now obviously you can set your limit order, or you can enter with candle confirmation. Personally, I prefer candle confirmation as it ensures a little bit of extra probability or confidence to get into the trade, and also it just increases the win rate overall as well. Now, with that being said, no matter how you trade, this still applies to any system. It's just the way you manage the trade once you're in it, okay? Because that's kind of the big and important thing. You can get the entries all you like, but if you're closing the trades a lot, for a small profit, you're going to get nowhere, because you're still going to let the full trade, for example, if it hits the stop loss, you're not going to learn to cut your losses pretty quick. You're just going to learn to, you're going to just learn to, if anything, adopt bad habits and learn to close the trade with a small profit and let your trade run and hit your stop loss if it's going against your way. When in reality, you need to reverse that and obviously learn to manage your winners and turn into a bigger position. But not also that, you need to learn to cut your losers. Okay, it might seem like a lot at first, but it's not. A lot of my students are absolutely killing it. I've got 7-figure students, funded students. I've got 6-figure funded students, 5-figure, 4-figure, you name it. Okay, and eventually the plan is to obviously get them onto the 6 to 7-figure mark. Okay, but anyways, with that being said, like I said, this applies to any system. So going back to the first scenario that I mentioned, close 50% at 1 to 2, let the rest run. So that pretty much just means, let's just say, for example, you're in a trade right now and you're up £500 with a risk of £250. That means obviously you're in a risk to reward trade of a 1 to 2. So what you can do when it runs to that 1 to 2 is you can close the trade with 50% partials off. So what does this mean? So for example, if you're at £500 with a £250 risk, meaning you're at 1 to 2 risk to reward, you take off 50% partials. That means you are now at £250. Okay, so you bank £250. Obviously with commissions and things like that, broker fees, it will be slightly less, but let's just exclude them for now. Okay, so let's just say you closed off 50%. That means you have banked £250, which is your initial risk. So that may be 1% of your account or 0.5% of your account. But anyways, you banked £250. From that point, you're still letting the rest of the trade run. But that initial risk of £250 is now not a £250 risk. You're obviously, in fact, risking half of that and letting the rest of that run. Okay, so £125. If my maths is correct, okay. But if my math isn't mathing, then I kindly suggest you to do the maths for me, but you get the idea, okay? Because obviously if you take half the risk off the table, that means you're obviously trading with the lesser risk on the rest of the trade. And so that's kind of one of the ways you can do it. It's just closing 50% off at the risk to reward of 1-to-2 ratio. And then obviously by letting the rest run, I just mean either letting it run to your initial TP. So for example, if you're targeting like the next available imbalance or the next available liquidity area or area of interest, POI, etc., that's up to you. But if you also want to learn how to manage your structure, then for sure stick around, as I'll show you some live examples in the real market as well of trades that I've taken and trades that are just there in hindsight as well that some of my students have taken that I'll review, but also show you how you can manage that with structure as well. Okay, so again, like I said, let the rest run. I'll jump into managing my structure very shortly. Okay. Another way you can enter the trade is with 2 positions. So this one is where you're going to allow or split your risk, into 2 positions. So this is better suited for limit orders. So if you're already using limit orders, then this is a bonus for you. This is kind of a better scenario. And I'll also show you a different, the same scenario, but on a different trade setup that I'll go into in a minute. But by entering 2 positions, I simply mean that if you usually get used to risking 1%, it might be worth just splitting that risk into 0.5 on opening 2 positions. So for example, what you're going to do is you're going to have one trade open targeting a 1-to-1, which would mean, for example, let's just say you're risking 0.5. Let's just say you target a 1-to-1. Obviously, you banked 0.5. Okay, then on the second position, you're going to let that run to the initial TP, and like I said earlier, that could be to next available balance or just managing restructuring, which I'll jump into later. Okay, now on the second position, this will obviously be a 0.5% risk as well. So let's just say, because a lot of the time you will see your trades run into a small bit of profit and then reverse. Okay, so if you aren't break even, or if you don't believe you can go and break even, that's fair enough, but using this methodology and this approach will definitely save your ass in the long run. Okay, so first trade, let's just say, is hit TP and you banked 0.5%. So now you're up 0.5% and you still got the second trade running. Now let's just say the other second trade is obviously running into profit and then it reverses and hits your stop loss. That means you'd obviously then lost 0.5%. But in reality, because you've entered the 2 positions, you split your risk. In fact, you have not lost anything. If anything, you're breaking even. Okay, because you've split your risk into 2 positions, and obviously your first trade is obviously a TP of a 1-to-1, so you kind of get the idea. That's one of the ways you can manage it in terms of risk, and that is a very quite a cool process, not often spoken about. It's something that I've developed as a scenario for my students that they can do. Okay, so if you want to do that and take that approach, that is completely fine and up to you. It's just more so if you back test and collect some trades, you can learn a lot about your system and you can run these different trial and errors and see which one is working best for you. So I'm just here to give you the scenarios and options that you want to pick and choose from, and obviously go down that route. But yeah, that's just one of the ways. Like I said, though, you don't need to risk 0.5%. If you want to risk 1% on each trade, that's fine. It's up to you and obviously your risk appetite and how much you want to risk. But obviously, be pragmatic, be realistic. Okay, you don't want to risk obviously 5% on each trade. That's just not long term going to be very good. Maybe even if you have a high win and win rate system. But what happens if you face a series of losses? You're going to be in deep trouble, or aka deep drawdown. Okay, so it's up to you and how you want to do it. And obviously, with that being said, I mean, you can even take it one step further and enter 3 positions, for example, with 0.25% on each, or 4 positions. There's so many different ways that you can do it and expand off from this. So, for example, like I said, if you've got 2 trades, you can even target the first trade using a 1-to-2 and then, 0.5% risk. And that means you've obviously targeted a 1-to-2, you banked 1% in total if you're using 0.5% risk, and obviously the initial TP on the second trade is still running. So there's many ways you can do it and many ways you can adjust it, but that's just one of the ways as well. And like I said, you can even open up 3 positions if you want to take that extra step further. So I believe, if you split the 1% into 3, I don't know what that'll be, but probably be around 0.3 or something like that. Something like that. But you get the idea. You can even split that into 0.3, which is quite a bit excessive. So I don't know if you want to do that. But for example, I'll just go ahead and say this anyway. So if you have 3 positions running, the first one's going 1-to-1, the second one's going 1-to-2, and the third one's going to 1-to-3, whatever. So many different ways you can do it. Okay, you can go ahead and trial and error and see what works for you. Now, Like I said just not long ago, I will show you a way that you can split the two positions into two different entries. Okay, so let's just say we have again a bearish market, prices creating lower lows and lower highs. Okay, we see a little sweep of liquidity here followed by a shift in structure. Okay, what you then can go ahead and do is you can mark up from the high to the low, and you can then, for example, mark up your order block, which would be the extreme POI. And also you can mark up the 50, not the 50%, the 0.71%, which is quite a common ratio for trades to be entered from, or a 61.8, but 71 just offers that extra little bit of risk reward. Okay, now in this case, what you can go ahead and do is you can set a limit order from this one, with your stop loss above the highs, and like I said earlier, if you want to target into that, that's fine, but it might be better to target into that off the 71. Okay, now also again, like I said, so this is how you can split it into two positions. So you can enter off the 71 with targets down into the lows and stop loss above the highs. Okay, you can also enter a second position with actually off the order block and target a 1 to 2. So at this point, you've got a 1 to 2 running trade. So if you get tagged in, let's say, you know, at the 71, price moves down a little bit, comes back up and tags you into the order block, and then hits your TP and then hits your stop loss, you've still banked obviously that 1%, assuming you've risked 0.5%. Obviously if you risked 1%, then obviously you'd be up 2%, but obviously you would have been, you know, you would have lost that trade as well, unfortunately. So let's just say you risk 1% on both. This one hit TP, you're up 2%. This one also just went and hit stop loss, unfortunately. That means you're down by 1% as well, which in total is 1% profit. But this is just a scenario that you can implement as well if you'd like to into your approach, in terms of entering off the 71 with a limit order and also the order block with a limit order as well. That's just the way you can do it. Okay, now lastly, managing with structure. Now this is very important to really understand. Now when it comes to managing with structure, I want to clear some expectations here. So if you're in, let's say, a buy position, right, price is creating higher highs and higher lows, etc., you're not always going to get it smack on. Okay, price may sometimes take you out of your trailing stop loss here and then just continue bullish and create a new higher highs and higher lows. That's just unfortunate and part of the game. Okay, we can't be greedy, we can't always catch every single bit of the pie, but our key is here is to try and catch a little bit of the pie and try and maximize it as much as we can. Okay, because it's like a lot of the bull run traders, what they'll do is they'll sit out all year and only engage in the markets when there's a bull run. During that bull run, they're constantly on the charts and they're constantly trading, but it just goes to show, A, you don't need to be trading every single day and all the time, but B, you also don't need to be, you know, involved in for example, range bound markets. So it's better to be, for example, trending markets, because when you are in a trending market, this is when you can turn into those big positions and catch those big winners. And obviously there's many more pros and cons, etc., around that as well, but you get the idea. Okay, so when it comes to managing my structure, like I said, I will go on a real chart and show you a couple of trades that I've taken, a couple of trades that my students have taken, but also I just want to go over this now and explain it in terms of a textbook example. Okay, so let's just say, right, we're looking for longs, right? Price is tapped into our point of interest, and at this point, let me just get rid of this arrow. I don't know why. OCD behavior, I don't know what it is. Okay, but let's just say at this point you're in a buy position. Okay, you've got your stop loss above, let me just put that there, stop loss above, I mean stop loss below, sorry, the obviously range low there. And let's just say you have an open TP, or, you know, like I said earlier, if you want to target a 1 to 2 with the first position and then let the rest run, you can still let the rest run, but we're managing with structure. So you can have a set TP of a 1 to 2 on this other position, and then you want to manage the rest of it with structure. Okay, so in textbook terms, let's just say you're in this buy position right now, so I'll go ahead and remove it anyways. But what you can go ahead and do is price is broke structure. Okay, at this point, would you move stocks to break even? Well, probably not. Why? Because there's still that risk of price coming back down to this order block, which would align with your potential break even, assuming you entered there after this previous order block. It just depends where you entered. If you caught it down here, maybe you could take off half the risk off the table. If your stop loss is here, maybe you can go there with your stop loss, but you probably wouldn't want to go break even after the first break of structure. Instead, what you'd want to do is you'd want price to pull back, create a new high, and then you can go break even and move your stop loss to break even. Okay, now would you want to move your stop loss just below here? That's fine as well. Let's just say what you want to do is, in terms of managing structure, prices keeps creating higher highs and higher lows and higher highs and higher lows, and then eventually you just want to keep trading your stop loss at least one behind every single break of structure. So like I said, if you want to trade here after the first break structure, you don't want to go to break even, but after the second break structure you can go to break even. Okay, when price is inside of this range high and range low, and let's say your entry is over here, well, more realistic, it's not going to be like catching a bottom like many traders claim to catch on social media, but I'm not getting into that. Okay, I'm just saying. But anyways, let's just say price obviously created this new range high and low. We've broken structure not once but twice, and potentially 3 times. Okay, now you can leave your stop loss at break at this point, or you can maybe move it just a little bit into profit, therefore obviously because you're just below the low. So you kind of want to be always one behind. So for example, price broke structure in this new range high, new range low, you can still move to this one or aggressively move to that one, because there's always a risk as well, because you got to think, okay, when you're trading like this, you want to see a closure below the low. Sometimes price may come back down to wick it and act as a liquidity sweep for price for more fuel for price to continue higher. So if you've got your stop loss too tight there, there's a chance of you getting wicked out and price continuing in your favor. Okay, which sometimes will happen. It's just unfortunate if you do move your stop loss that way, which is fine, but just keep that in mind. Okay, it will just sometimes be a liquidity sweep for price to sometimes continue higher. Okay, so that's why if you want to be a bit more reserved and a bit more conservative, you can just follow it one behind. So like I said, if you're in this range high and low at the minute, you can just place it behind this one, and then obviously once you've got this one here, you can place it behind this one. Once you've got this range high and low here, you can place it behind this one. That's the more conservative approach. If you're managing it aggressively, you'd obviously follow it after every break of structure below the low, but just don't put it exactly on the low. Just give it a little bit of room to breathe by a couple of pips at least, because you're just still accounting for spreads, obviously, because when price comes down here, if you're trading, if you're on a raw spread account, fair enough, but obviously if you're trying to acquire prop firm for them, you are going to face spreads. So when you're down here, it may not take you out on a raw spread account, but it may take you out on obviously a prop firm account, because you still have to account for spreads. So that's just something to keep in mind as well. Always account for spreads. But you get the idea anyways. So basically at this point, you're still being a trade, assuming you managed it correctly. And then obviously, yes, you will sometimes, well, at some point price is going to reverse to collect all the previous liquidity that is generated previously on that bullish move. Okay, so let's just say you got the stop loss below here at this point, you are going to get taken out, and that is where you'd want to ideally trade, close the trade. Now you can trail your stop loss, okay, or you can manually close it. That's completely up to you. Okay, but that's kind of the idea, and like, it still applies to the opposite scenario as well, but that's kind of the idea and the approach you want to take in terms of managing the structure. Okay, now I'm just going to show you a trade here on GU. This was from today, and you can have your initial targets as well. For example, price is inside a 50-minute bearish range and a high time frame bearish range, so ideally what you can go ahead and do, because this would be a high time frame low, which it was, and this was a high time frame high, which it was as well. Okay, so you can probably see a little bit more clear on the hourly time frame there. So if you're trading on a low time frame with inside of the high time frame as well, then obviously you will have your points of areas where you want to close out the trade. So for example, targeting down to this, that would be a good option. Internally, if you want to target down to this low, that's fine as well, but that'll just obviously be your lower time frame low. So for example, the 15-minute low here. Okay, so pretty much as you can see here, we had a previous sweep of liquidity, and also this was a previous Asia session as well, which I won't jump into today, but this is just something that acts as liquidity for us. Okay, anyways, price swept liquidity. We've seen a shift to the downside here, and then obviously we have this imbalance left here behind here, which is partially taken before, but also we have the clear imbalance there, which has not been collected. Now also you can look at this as well as a potential liquidity area. So for example, there'll be many shorts off this area here, but to be honest, when you look at this bit of move here, I'll give you guys a little bit of secret sauce here. Obviously I map my structure like this, but would I map it like this in this case? No. Why? Because there's no imbalance. Okay, so you can refer to the previous range high. Anyways though, we want to keep the initial TP in mind, because obviously we want for price that this is just a high time frame pullback. Even though it's creating these breaks of structures here on the lower time frame, this is still within a high time frame pullback. Okay, so that's why it's important to trade with the high time frame in alignment with the lower time frame. Okay, so anyways, as you can see here, pricing mitigated our area of interest. So like I said earlier, if you wanted to, you can enter with a 0.71 there. So for example, if you enter a short position there as well, You can enter the short there, target down into these lows, and then you can also have another short there with a risk reward of a fixed 1 to 2. Why 1 to 2, you're probably wondering? Because it just works good. 1 to 2 from especially my data collection just works very well. Okay, 1 to 3 might be better for you, but that's something you must test if you want to take your own route. Okay, obviously if you want to undergo my mentorship and learn the exact way I trade and my approach and the way my students are trading to achieve this 7-figure funding, then sure, join the mentorship and you'll learn my exact way. But that's just kind of a rule that you can follow in terms of that if you want to go your own way, right? But yeah, you get the idea. So like I said, however many ways you want to trade it, that's completely up to you. But what I'm going to be showing you is the lower time frame on the 1 minute for my entry, but also the managing the structure side of things as well. Okay. But again, it's always important to keep the lower time frame, high time frame in mind. For example, this here was just a short-term reaction of this internal POI, just a short-term lower time frame pullback. Okay, broke structure. This looks like a lower time frame pullback. This here, obviously, you'd be closing out the trade down here because obviously prices have reached our initial area of wanting to close the trade. So if you're getting a random reaction, for example, from here, then either it may just be the wrong potential POI to trade from and price continue bullish to reach the next available POI. But sometimes if you're just getting a random reaction off, like that's not been, for example, off a POI, like for example if it's reacted to this and then shifted bullish, then yeah, I see your reasoning for closing the trade. But if it's just randomly shifted bullish, obviously there's a chance of it continuing in reverse and it's the wrong POI you traded from. But if you've got the correct POI that you're trading from within the high time frame in alignment, then it's just randomly shifted bullish, then that's not going to be significantly or a convincing bullish closure. Okay, anyways though, let's just jump onto the lower time frame. Okay, now there are many different entries that you could have taken, but I'm not going to discuss which ones my students would take. If you're in a community, you can go ahead and see that. But let's just say we're in a short position from, I don't know, let's go here. Okay, and we're in this short position now, and we're targeting down into these, not only these lows, you can take partials there as well if you like. If you want to take that route, for example, target into the internal low and then the higher time from external low. If that's something you want to do, great, good on you. Okay, so if you want to just let the trade run, that's fine. If you just want to approach it as set and forget, that's also another option. But I'm just trying to help you not have the smaller positions and try and turn it into a bigger position, essentially. Okay, but anyways, when you look at this bigger picture here, if you just zoom out like that, you can clearly see straight away a price has rallied, pull back, rallied, pull back, rallied, pull back, rallied, pull back, rallied, and then obviously the pullback, which is a shift in structure there. Okay, that's looking at the bigger picture. When you look at the minor details, when you zoom in, you can see it a little bit more clearer. So this is also another little potential entry there based on this breaker, but I won't discuss that. But you can use that as a scaling if you want to take it that extra level. You can scale into trades, for example, have a nice trade there, stop loss above here, and obviously targeting partials there, whatever, right? That's just a way you can scale into the trades. But like I said, I'm just showing you managing the structure. Anyways, you're in the trade right now. Okay, we formed a new range low, and the range high is all the way up here. Okay, broke structure, range low, range high up here. Okay. This point you see on the trade, we've got the new range low there and the range high, price respected it. Okay, and all of these mini ranges that you're seeing, price is still respecting the structure. Okay, range low, range high, price didn't close above it, more so just wicked it. Okay, so you wouldn't really be convinced on price potentially changing bullish at this point. Now, even though we are approaching the overall, not all-time lows, but you get where I'm coming from, the high time frame lows, you still don't really want to close it just yet. Anyways, price broke structure here. New range low, new range high. We then go into a bit of a consolidation period. Would I be convinced on this is a bullish shift? No, because we're not seeing the momentum. We're not seeing a push afterwards, okay? For example, if you compare this little break here over to here, that's more of a clearer break than it is over there. And also, when you look at what price is tapped into, this is also another bit of free source as well. When you look at what price is tapped into, where the pullback is coming from. So, for example, if you're looking to, I don't know, sell, right, and prices, or let's just say you're looking to buy from, let's say, over here, and prices just pull back after tapping into a previous POI or a high time frame POI, and this is a counter trend long, and you know that, but you're looking for a short term move, then this would be a lower probability trade. I'm not going to say it's a trade that you shouldn't take, because I'm not like that. I'm more of a believer like Mark Douglas. So, for example, there's no right or wrong in a market. Everything is probabilities, okay? Because you can have a beginner come on the charts who randomly places buys and randomly places sells, and he will be right some of the times, okay? But actually being consistent on a long-term scale is where the is where the real traders are come from. Okay. Anyways, what I'm trying to say though, if for example, if your pullback into the POI that you're looking to trade from has come from a form of POI mitigation, then this lowers the probability of this POI holding that you're looking to buy from. It lowers it. But like I said, doesn't mean it's not gonna not hold and not continue in your favor. It's just something to keep in mind. Okay. And there is something that we trade in ZCFX, which is using chains. So supply and demand chains, that is something that I've done videos on in the past, I believe, but that is something you can apply in as well. So for example, if you had this high marked up and let's say prices broke structure here, would this be convincing? Well, no, because we still have this supply zone there that was clearly mitigated. Okay. Anyways, though, as you can see there, price continued breaking bearish. New low, etc. News lows were just being printed in the market at this point. And as you can see, because we're trading with a higher time frame, the higher time frame lows has now been taken. So if we do get a shift bullish, then yeah, I might be more inclined to close the trade. Anyways, as you can see there, we get the range low, we get the range high, and as you can see, this is a bit more of a momentum shift to the upside, so you can probably get away with closing the trade there for a nice win. I mean, if you include supply and demand, etc., you still be in the trade, obviously, because it's a supply mitigation based on this previous mitigation. So that's a nice little supply chain there. But that's just kind of how it all kind of works. You don't want to be, for example, closing any just random shift. If you want to, that's fine. Trial and error, see what works for you. Like I said, if you're in my mentorship, then you'll kind of know how I trade exactly to the T, and you can ask me questions, etc. But don't overcomplicate trading. I feel like a lot of people, they usually try to focus on the outcome, especially the outcome is in result of money. And obviously when you focus on money, it just seems to end in tears, because money shouldn't be a thing to inspire people to trade. Although it's nice, it's more so a byproduct of the way you trade, but it should just be used as, for example, a tool to actually trade, because without money in the markets, we wouldn't be able to trade. Okay. But like I said, though, that's kind of one of the ways you can manage to trade with structure. And if you did close on that first shift there, which is completely fine, that's still an 11R position, because you're still using high time frame in accordance with the lower time frame. Okay. And we do catch huge trades like this here at ZCFX, but it's like, for example, if you were down here and you targeted a 1 to 2, you're missing out on a huge potential position here. Okay. Because sometimes you can go on and catch a huge ass position. You can, but because you closed out earlier, you've missed out on that. Okay. So what's gone from the 2R position, for example, or even if you're closing, like, for example, at this low here, or because obviously in hindsight you've seen the candles form, but in the moment you're seeing these candles form here, and I can tell straight away that this candle is opened, we formed a potential bullish candle here, and a lot of people would just generally close the trade here because they've seen that bullish candle forming. So that's just another lesson in itself as well. For example, waiting for the candles to close. But that's kind of one of the ways that I was just trying to get across, in terms of, a lot of traders, you probably experienced it yourself. I've experienced it in my early stages of my career. I'd enter a trade, I'd see it go into profit, and I'd be scared to lose it all, because I don't want the trade just reversing on me. Okay. So like I said, that's just one of the ways you can do it. And well, one of the many ways you can manage your trades. And just remember, guys, like I said, trading does not need to be overcomplicated. You don't need to, think of it, overthink it. You need to just keep it simple. You need to just relax a little bit, is the word I like to say. Just chill out a little bit. A lot of people just heavily overcomplicate it, put themselves in so much stress. And, if you are lacking a little bit of confidence, like I said, just go back to the things that I've said earlier in the video. But the more you do this, the more you get used to it, the more you condition yourself to it, the more you're just generally more inclined to manage your structure, etc., the approaches you want to do. Like I said, though, you can still, for example, target, for example, like the 1 to 2 there, if that's something you're used to, and then just open another separate position to manage with structure all the way down there. So obviously in total it's like an 11R. Obviously, if you risk 0.5, it'll be half of that. So 5.5, if my maths is correct. And then obviously 0.5 on this one as well, so you'll be at 1%. So in total, it'll be 6.5%. And that's pretty much nearly just the phase 1 challenge passed on an FTMO. And talking about a phase 1 challenge pass, actually, one of my top students, Jack, he has just passed phase 1 on an FTMO, funnily enough. So that's pretty cool to see. But yeah, that's pretty much, like I said, the way you can manage your structure. Now, I will go on and just quickly jump onto another pair. I believe we are on quite a bit of a longer video here, but hey, who cares? You know, at the end of the day, 30-40 minutes out of your day or out of your week to just really learn and develop something new into your system in terms of the trade management, it's worth it. Okay, as you can see here, this exact setup is exactly what happened over here. Okay, price repeats itself. That's just a little clue as well. As you can see, we took out the high there, we took out the high here. It's just something you see, especially during these times on this pair. Anyways, though, we're in a short position here. The high time frame lows is obviously here as well. So ideally, our initial target, we're expecting price to go from A, which is which is obviously here, and then B is obviously all the way down here. So we'll be looking for price to go from A to B, and then obviously we'll be wanting to manage the structure as well, because again, there's always that chance of price coming down to here and then reversing, continuing bullish. Okay, so just managing the structure is just a general good way of securing securing. So there's a couple of pros to it actually. So number one is obviously managing the structures. The main pro is obviously if you are in like a big position and price is just rallied like this, you are going to be in a huge ass position. Okay. B obviously is you're securing or taking as much as you can from what the market giving you. So yeah, and also as well, there's another general rule as well when it comes to trading. The hardest part of trading, the easiest part is actually analyzing the market at your points of interest. The hardest part is actually having the balls to execute once it plays out. Okay, but anyways, this is actually a short position that I had taken myself, and a couple of my students actually caught this with me as well, but I took an entry over here, and one of my students took an entry over there, which is pretty awesome to see. But at the time, my chart was pretty little different, so I had this high and this low marked up, and price shifted there. Okay, whereas when I look at this on a different chart that I pulled up for this video, it shifted there, so that makes sense, right? So anyways, we'll just roll with the entry from this one for now. This is pretty simple. Obviously, stop loss would be above the highs there. And again, we want to keep the initial TP in mind. So that's a pretty big position there for an 8.65R straight away off the bat. And obviously if you scaled in as well. So scaling is kind of something I'll talk about in a different video, but scaling in is very, very important if you can do it. That's just really maximizing your potential. So for example, rather than just entering, no matter how you enter the trade, but let's just say you're up 8.5R, why not get an extra 5 to 6R from the trade if you can? Just using the scaling opportunity. So that's pretty cool if you want to do it that way as well. But yeah, let's just go ahead and target down into those lows there, and let's just manage your structure. So first things first, as you can see here, we've taken out these lows here. Okay, we formed a new range low, a new range high, nice scaling here, which I just discussed. We then formed a new range low, and it's range high up there. Price just breaks bearish. We formed a new range low, and would this be a range high? Well, I mean, if you really wanted it to be a range high, yes, that could be a range high and you would close out potentially there. That's fine. That would still be a nice little position. But obviously when you factor in the bigger picture, the high time frame, etc., you wouldn't really want to go close based off that, okay? Because this wouldn't really be a convincing shift as opposed to price coming up and taking out the previous high there, okay? And also as well, just a little general rule of thumb, is you can look at where prices previously reacted from. Okay, because where price is previously reacted from, you're more likely to see price come back up to that similar area and then continue in a direction as well. So as you can see here, price mitigated this breaker, we then reacted from this area. So until price took out these highs, I wouldn't really be convinced on to close the trade. So the range high, or let's say the range low is up here. Okay, as you can see, price mitigated this area there, going based off the previous mitigation, aka supply chain. So if the structure did shift bearish or bullish in this case, did supply lose control and did demand take control? Well, no, it didn't, because supply is still in control up here. That's just one of the little things I like to discuss. Anyways, range low was taken out there. We had a new range low, new range high. Price obviously came back up and mitigated the premium side of that range. Breaker structure there, new range low, new range high. Okay, mitigate the extreme of the range there. Then as you can see there, so we took out the low at this point. So if you were targeted down into the low, and if you wanted to close after that point, that's up to you. Anyways, range low, range high, price came back up, mitigate this area pretty nicely. Okay, took our structure again, we had this new range low. Now at this point, this is where you can go in based on those smaller ranges like that, because price has already took out the high time frame low, and obviously when price takes out a high time frame low, you can expect to pull back at some point. Anyways, though, if you took it out, close it off this one, obviously, if you'd waited for the candle closure, you would have closed out there. Obviously, this is a fundamentally driven move as well, half free. There was news that was released at that time, so that's kind of, you know, when you're balancing all these different things in the news, etc., it may change your bias completely. But obviously, it's important to keep out for the news. But that's why, if you trailed the stop loss, if you had waited for the candle to close, that's fine. If you trailed the stop loss, then that's also fine. So you kind of just have to find a balance to see what works for you. Okay, because if you wait for the candle to close, you would have closed up there, assuming you didn't wait for the pullback after the news to calm down. But if you trailed your stop loss, you could have trailed your stop loss there, or just a few pips above there, and you would have been taken out automatically. Okay, so like I said, those are many ways you could do it, but that's just kind of how it works in terms of managing the trade with structure. And if we just go back over here, news was kicked in, it kind of messed price up a little bit, as you can see. We're kind of just consolidating this bigger picture there, but still, you know, when you go back based off the previous mitigation, you can't just argue that it mitigated this area there anyways. Okay, but anyways, as you can see there, price continued bearish, and obviously we'd look at this area potentially break, but then obviously we had this pullback, we had this new range low, range high. The price obviously then broken above these areas there, so you could have closed there as well if you didn't over here. But anyways, below this point is where you'd ideally want to close, somewhere within this range, and you don't need to get it perfect. Okay, you just need to make money. You don't need to try and close out all the way over here perfectly before the market reverses. It doesn't matter if you close that all the way up here. Okay, you're still catching a nice position. Let's just say if it did shift there and continue and you close out there and panic, okay, you still caught a very nice trade. You don't have to always wait for price to, you know, go on and take the highs, etc., from that point onwards. But yeah, that's just kind of it for this trade as well. I'll also jump on to EU and show you a couple of examples here. So I won't go into too many examples because we'd be here all day, but the ideology is, if you're in a nice trade, manage your structure, because if you got trend on your side and price is trending, you got the high time frame aligned as well, you can go on and catch some hugely nice trades. Because for example, this was a high time frame range high, this was a high time frame range low. Okay, this is a previous range high that price obviously traded or broken above on the high time frame, and then obviously it broke structure down here, so obviously inside of this bearish range high and low, okay, on the high time frame. So all we're looking to do is trade the lower time frame in alignment with the potential higher time frame. Okay, so anyways, we've got the pullback on the bigger picture there, and then as you can see there, this is similar to GU as well, but this is an eternal high because price didn't take the low. Okay, so there's a bit of divergence between EU and GU there. Anyways, as you can see there though, price had obviously swept out liquidity in previous highs there with the wicks, and then we shifted bearish. Okay, we took out some structure here. Not only did we take out this structure, but this structure and this structure. That's pretty irrelevant for a different video, but you get the idea. We took out the structure, we have this range low, and we have this range high. Price mitigated our area of interest, so we can go ahead and mark up this low, and obviously the high time frame low as well. When we jump onto the M1 time frame, as you can see, there was a nice internal entry, and this is actually a trade that a couple of students of mine taken as well. So great to see my students. I don't like boasting about my students all the time because I don't want to push it down your throat, but it is just hard not to sometimes because my students are just generally are killing it. Anyways, though, price obviously broke below the wick there, but when you go based on the internal structure, which is what they did, they got an entry, I believe, is around here or somewhere around here. Anyways, though, price came back up. We traded back into this area again. So let's just say we entered the short initially. Let's just go with, I don't know, this one. But let's just say we had to stop loss above the range high or above the overall high. That's fine. Overall high or up there is fine. Obviously, range high would be there, but overall high is there just to be safer. So it's up to you where you want to place your stop loss. So let's just say we're targeting to the internal low, and also we have the overall low as well. So you can take off partials at these levels. There's so many different ways you can manage it. Like I mentioned, I'm just here to just show you a different couple of options that you can do. You can have TP1, TP2, etc., and take off partials at those levels and whatever. But anyways, as you can see here, this is pretty straightforward. So price broke structure here. We had this new range low and range high. Price had just pulled back and mitigated the premium side of the range there. Broke structure to the downside from the new range low and high. We then also broke structure to the downside there again. New range low, new range high. Okay, price had pulled back, mitigated something within this premium side of the range, and then broke bearish again over here. Okay, now these are just small ranges. This is more so of a consolidating period, but again, still keep the high time frame low in mind. As you can see, we just more so respected the lows, the highs, the lows, the highs, etc. inside of these mini ranges. But as you can see there, if we just take a look at this low here, and we had this range high there. I mean, if you want to include that high there, it's fine. It just create equal highs. But either way, if you had closed out after this closure here, or trade stop loss just above there, you would have been stopped out, because like I said earlier, prices took out a hard time from low, so you can go in a little bit aggressive if you'd like. But not always will price, for example, you know, take out the low and then, you know, reverse. It'll sometimes just continue. So if you want to still be a bit more conservative and have it above the overall range low high like that, that's fine. Okay. Anyways, price came back down, created a failure swing there, and then more so just created more equal highs, just generating liquidity to the upside there as well. And as you can see, price unfortunately finally then closed above these highs there anyways. So you would have closed out around there if you didn't manually or automatically been taken out by via managing restructure. Okay, and as you can see from that point, price just reversed, and if anything provided long opportunities. But I won't go into that. That's just a separate system that is, well, myself and some of my students trade based on the potential anticipation of a pullback there. But yeah, that's pretty much it really for managing your trade restructure. I can sit here all day and give you, you know, examples here, there and everywhere, but I'm not going to do that because we'll be here for literally all day. But like I said, guys, thank you so much for taking your time to watch this video if you're still here. Make sure to drop a thumbs up if you want to see more content like this, and if you are interested in becoming a 6 to 7 figure funded trader within the next 6 to 12 months, then I'd highly suggest you check out the mentorship as well. But hey, if you don't want to, that's fine, but hopefully this video has gained you a lot of value. I'd love to see you in the comments below writing down some notes from this video that you've seen or taken away. So yeah guys, thank you so much for watching, take care, and I'll catch you on the next one.